Wow. I've seen a few clips and images of the California fires. It really just seems apocalyptic, really, for lack of a better term, in how some of these landscapes are and some of the before and after photos. Like, we're literally seeing this clip right here of this structure basically completely engulfed in fire and how it's actively sort of decomposing and falling apart at this point in time. This was such a travesty, I'm sure, for a number of people in that area. I'm curious to see what they're going to cover in this topic today.
I never thought that this fire burned down our house. I didn't even think it would. And especially all three, I was told that 56.
What does she mean by three? I wonder if this is if she basically bought maybe three homes in the same area, like if she's like a landlord, or if she means she had a house burned down, rebuilt it, that burnt down, rebuilt it, and it burned down again. That would be a really terrible scenario if it was the second one where you're just continually rebuilding your home and continually losing it. That certainly seems like a sign that you should be leaving that area if that is the case.
Out of 60 burned on our beach. I don't know how much burned in my own neighborhood, but I keep running into people from the neighborhood, and most people's houses are burned.
The first weeks of the new year were marred by destruction and devastation in Southern California as several fast-moving wildfires burned through 63 square miles of the Los Angeles area, leaving more than 14,000 structures, including homes, businesses, and schools, decimated in their wake, and killing at least 27 people. Damage and economic losses from the disaster are estimated at $275 billion.
That is a lot of money. It does make sense because of, they said 14,000 structures. Homes in California are millions of dollars each. So it makes sense that when you add those all up, it's going to add up to billions of dollars. Plus, there's other things that are in here that would likely be included, not just personal homes, but the personal property items, maybe vehicles, infrastructure. It goes on and on and on. It was such a large area that was actually impacted by this.
Insurers in the state now face tens of billions of dollars in payouts.
It's going to be a massive number, and the full scope of the damage is still unclear, but preliminary loss estimates are running in the range of 30 to 50 billion dollars, and that.
Yeah, so this is something where they've actually highlighted in the past how some insurance companies have been leaving certain problematic areas within the US. I think flooding in Miami and Florida, I believe, and this fire area in California, especially due to policies and things like that, it's just becoming untenable to not just drastically increase premiums. And I think for California in particular, I believe that they had put in some legislation to basically prevent insurance companies from increasing their rates too much. And I think they basically had some stipulation. I believe it was around the effect of you couldn't use projections of natural disasters into accounting for the premium rates, basically saying, even though you see fires are increasing over time and that more and more destruction is happening, you can only use historical data. And I think this made it so that basically what happens for insurance companies is that you can only recoup the cost or increase your premiums after a disaster has happened and you've already paid out the full amount necessary for rebuilding that home, etc. And that's what they mean by the losses here, which is where the entire point of insurance is that you're hoping that you pay a small amount to avoid paying a large amount yourself in case of a somewhat rare occurrence. But for these occurrences that are becoming more and more prevalent, let's say for this area, if 50% of the houses are there and they're all gone this year, that means these insurance companies have to potentially pay out, I think they basically said like 30, 50 billion. And your home insurance premium is certainly not in the billions, I can't imagine. Certainly not in the millions of dollars either. And so most of the time, these are possible by people paying premiums year after year after year. And then they sort of stockpile cash for these emergencies. And so just from the aggregate income from these small payments, it's enough to offset the large expenses that they need to help certain individuals with. And so this is where if you don't have those ratios correct, then you could end up paying out a lot more than the amount of money that you're getting in, which is causing problems for the insurance companies. And then the insurance companies are basically not insuring homes and families. And then this is becoming problems for those individuals as well.
Will be the largest fire-related catastrophe globally in history.
Some people liken the insurance industry to the canary in the coal mine for the climate crisis. The canary is just about dead.
Adding to the chaos is a shifting and at times confusing California homeowners insurance market. Since 2022, 7 of the top 12 insurers in the state have stopped renewing.
Wow, 7 is quite a few. This is where, I just mentioned this previously, so this is where it's so hard for insurance companies to basically maintain paying out these large deposits for basically rebuilding homes and for these policies. And so it makes sense. This is where insurance companies aren't trying to go bankrupt or lose money. They're not doing this as a form of charity or something like that. The entire point is for them to get money in, actually have a bit of an overhead so that way they can pay themselves, their employees, and then still have some left over to actually handle the catastrophes that occur that hopefully happen at such a rare occurrence that it should be negligible to compare to what they are gaining in and what they've had in reserve. And so this is definitely shifting here. I think there's a great point that they're bringing up of climate change, because we've been seeing natural disasters increase for sure in the US, and I'm sure globally as well. And so there's certain areas of the US that are now becoming very problematic. I think this is something similar to like New Orleans, for example, or Louisiana, and how there was various hurricanes that were there and people were basically becoming devastated year after year after year. And now that same scenario is happening in a variety of other locations as well, because they're in particularly vulnerable geographic locations. And so I'm not entirely sure how they're going to fix this problem. Like, the only way they can realistically do it is if they can drastically increase their premiums here, or they might even need to find some way to encourage these individuals to move, or get maybe government funding for insurance and have like a government backed one or maybe a state backed one to help facilitate this program. But at the end of the day, this is something that we're going to have to solve as a nation and also globally, which is what do we do with the people who are living in these locations that weren't particularly problematic maybe a decade, 2, 3, 4 ago, but are now becoming increasingly dangerous for them to live. And these people have their entire lives set up here. Do we just give them new homes in a new location? Is that fair to people who are working and having to barely make ends meet to make a living where they currently are that is less vulnerable? Do we just have these people kind of find a way to move on their own and we just let them suffer and they don't get these insurance policies backing them in case of these emergencies? This is a very tough situation to handle. If you have thoughts on how you think this should be done, or if you've seen this done well somewhere, please share those in the comments. I'd definitely be curious to hear your thoughts on that.
Writing policies in high-risk zip codes. Other insurers have pulled out of the state entirely. And it's not just Californians who are facing severe climate risks. 44% of all U.S. homes are in areas that face at least one severe or extreme climate risk. That includes flooding, wildfires, heat, wind, and air quality risks. So that leads many to ask.
44% is such a high percentage. That is not what I would have expected. That's practically half. That's such a phenomenally large percentage of the US. So I'm not sure if that is over a certain span of time, or if not all of these risks are created equal. Hopefully they'll expand more on that.
Do insurance companies have the reserves to cover this disaster, and what will be the cost for homeowners to insure properties in the future?
This is going to take years to rebuild in this area. The cleanup is going to take months, but I'm also concerned once we rebuild, whether we will be able to find insurance. Those are some of the lingering questions that I wake up at 2:30 in the morning and think about.
Yeah, this is where if you're going to be rebuilding your home, I think people should be taking some serious thought into, should we move someplace a little farther away from where these disasters are happening if they are getting paid out those amounts, or if there's some way they can leverage that payout to then get themselves into a better position in the future.
Joan Zoloth lives in the Rambla Vista section of Malibu. Her family owns 3 houses in the area: Zoloth's home, a beach house that belonged to her parents, and her son's home. All 3 burned to the ground in the recent fires.
So this is definitely a tragedy no matter what happens. However, again, I think this is maybe a weakness of CNBC themselves of, I'm not sure why they would have chosen this individual to be like the spokesperson of this disaster. Having some individual who has 3 homes that they own for whatever reason, they've been wealthy enough to buy their own home in a very scenic, very high cost of living area for themselves, their parents, even their children. That is a very privileged individual. And this is where, just because you're privileged doesn't mean that like bad things can't happen to you or that people shouldn't feel bad for you. But I do think that these things matter in the context. And so showing somebody who has arguably, I would have to assume, tens of millions of dollars of wealth just in their homes, if not more, is not necessarily the most sympathetic individual to highlight this case for. And I think I've seen this happen in a few other videos where they're trying to highlight a point, which I think is a very valid point, but then they use somebody who is like this outlier, who's like a upper class individual, to highlight a struggle of what most Americans are dealing with. And I feel like it kind of takes some of the wind out of the sails of the argument when you're asking people to empathize with these people, and the average person in America is struggling to have any home or pay rent, never mind have 3 homes on the beach in basically one of the wealthiest areas in America. And so again, it doesn't change the fact, I think I still agree with the premise of what they're covering here, but it is something that I wish they had changed about this, which is finding, maybe a more average individual who's in this scenario. This couldn't have just all been multi-home owners worth tens of millions of dollars that were impacted by this disaster. And so it seems odd to me that they keep choosing these very wealthy, affluent individuals to represent these very serious issues that are occurring.
And there's so much loss that it's devastating. I mean, my son is complete shock because he lost everything at his house.
Zoloth purchased her property last summer. At the time, she applied for homeowners insurance with USAA, a financial services company that provides insurance to members of the military and their families. The company rejected her application.
And when I said, look at our policies, look how long we've been USAA members, the person was incredibly dismissive and said no, and not giving any reason, just said, we're not going to give you a homeowner's policy there at that address. And I was really devastated because my parents had been policy holders since probably I was 6 years old.
California homeowners.
From the way that she described that, it's possible she's just using these terms oddly, where maybe this is a scenario where she owns her home, her child owns their own home, and her parents own their own home here. But she keeps referencing that she has lost 3 houses, so it's a little confusing here on how she's kind of like going back and forth between who owns what, just to kind of correct myself in my recent statements. It is possible she's just saying her family has lost 3 homes, and that would definitely be a different scenario. But I think still, again, true where I'm not sure how many individuals in America would be able to afford independent housing for themselves, their children, and their parents to all have homes in a very affluent area. So maybe they're not very upper class, depending on the interpretation of what they're trying to say here. So I do want to take back a little bit of what I said, just in case this is just some type of communication issue that she had or some slip up in how she's describing it. But again, it is very ambiguous whether she means she actually owns all 3 homes or if it's just her family that happens to own all these homes.
Like Zoloth have faced a dwindling marketplace in recent years. The state's largest insurer, State Farm, announced in 2023 it would stop writing new property insurance policies in California, citing construction costs and increasing wildfire risks. 9 months later, it discontinued coverage for 72,000 homes and apartments in the state, citing the company's financial health, inflation, regulations, and exposure to disasters. By 2023, State Farm's California surplus was down to $1.3 billion, compared to a $4 billion surplus in 2016. More than half of California's 39 million people are estimated to own their home.
The climate's getting worse, and we're having more extreme and severe weather-related events that are causing more damage, that are causing higher insurance payouts. But we're also shoving more people and businesses into harm's way.
Well, over the last decade, for every dollar of premium, homeowners insurance premium that we have taken in as an industry, we've paid out $1.17 in claims. Now
That's a really big point that he's highlighting here, which is for every dollar they're getting in, they're actually paying out $1.17. So this means by insuring people, they are inherently losing money at this point in time, which is exactly why this is becoming such a problem, which is where if insurance companies are losing money, they aren't a government agency. They're not for the public good. They are for-profit companies. And so if they are actively losing money, then they can't function as a business. Nobody can other than maybe the government who can print out their own money. So this is something where it's just completely unsustainable, which is why these things are starting to balloon out into much larger and serious issues.
simply not sustainable. There is no endless pot of money that insurers have to be able to pay that kind of claim ratio.
And it's not just California homeowners facing hardship. Insurers have also been limiting underwriting in parts of Florida, Louisiana, and Texas as natural disasters grow in intensity and cost.
And as a result, we have these more extreme and severe wildfires, which become catastrophic and kill people and injure people and damage homes, and then also make it very challenging for insurance companies to keep writing insurance.
State Farm said in an email to CNBC that it is focused on meeting its customers' needs and that it is working closely with the state of California to create a sustainable insurance market. USAA did not respond to CNBC's request for comment. On top of the severity of disasters, California's regulatory environment adds another hurdle for insurers.
Part of the problem is there has been rate suppression in California due to Prop 103 regulatory framework. In other words, the rates that have been allowed for insurers are far below the actuarially indicated rate that's needed to cover the risk of loss.
Proposition 103 passed in 1988 and required the state's Department of Insurance to approve property insurance rates and ordered insurers to roll back rates by 20%.
Particularly in California, insurers really up until the last couple of months couldn't use risk modeling in California in their rate making. There was prohibition against it, and so they didn't have the benefit of having the latest data when it came to making decisions on their risk appetite.
And rising costs are another issue.
Over the last 5 years, construction services, that is the carpenters and the labor, that cost has increased by 35.1%. And the cost of construction goods, materials.
This is another great point that's getting brought up, which is especially during COVID and the times that have followed, inflation has grown quite a bit and the cost of goods and other services have increased a noticeable amount. And so again, this is where multiple things are hitting all at the same time for it to be this problematic.
Has increased 37.3% over the last 5 years as well.
The loss of home insurers in the state has forced many homeowners into what is called the insurer of last resort, the FAIR Plan. The FAIR Plan is an insurance pool in which all licensed property insurers in the state must contribute to. It offers coverage to residents and businesses in vulnerable and wildfire-prone areas who can't obtain coverage from private insurers. Between 2023 and 2024, the FAIR Plan saw 40% year-over-year growth in policies statewide.
So they're sort of highlighting this as like a negative, like these people are trapped. They have to pay into this. this seems reasonable to me from like an economic standpoint, which is if there's basically a group funding effort to effectively replace insurance, because again, there's a way that you can, in the grand scheme of things, insurance is there so that you don't have to have the large amount of cash stored to offset one of these issues. And generally speaking, the way that insurance works is that you're supposed to be able to pay in a higher premium than what is claimed from them, even though that's the opposite at this point in time. And so that means theoretically, as a counterexample, you could individually insure. This is what happens for a variety of purposes. Like for your pet, for instance, you might not have pet insurance. You are self-insuring at that point, which means you just have money around or you just expect to pay it out of pocket yourself whenever that happens. And you're expecting those expenses to be rare enough that you're not going to do it, or for any other type of insurance that you don't actively participate in. And so at least what this sounds like to me is that this is a community-based policy where people who are in this particularly risky area all pay into this plan together, but then they pay at cost of how much it takes to actually replace the buildings. And so there's likely less overhead than there would be for the insurance companies, and that these growth rates are likely accurately reflecting how problematic it is to live here and how likely your home is to be destroyed in a natural disaster. And so again, they sort of stated this as like this is unfair to the Californian people. But again, if you have a group or a communal insurance policy, likely this is going to be a lower premium option compared to what the insurance companies would need to do in order to make it sustainable. And so they're only charging however much, based off of my presumption of how they described it, as would be necessary to maintain insurance adequately for that area. And so again, this is people are making the choice at the end of the day of where they want to live and whether they want to insure their home and stay there, or whether they are going to try to relocate or maybe take claims from past issues and maybe try to relocate someplace else. And so people are also making the active choice to remain in this area, even though that might be tough because there might be work and employment opportunities there. This is still a choice that you are making. You are still responsible for where you choose to live, and especially in a scenario where you are potentially getting claims and have the opportunity to move, which again, these are for the homeowners in this case. This isn't the renters. This isn't homeless people. They're specifically covering individuals who have purchased a home here and have had issues with gaining insurance due to the likelihood of disaster.
In the Pacific Palisades, FAIR Plan policies grew 85% year over year.
We had to go with the FAIR Plan. This is incredibly shocking and devastating, and there's a lot of losses there. And I know that FAIR Plan must be incredibly overwhelmed with all these people calling and all these people needing help.
Now, the FAIR Plan could be on the hook for $8 billion in losses from the fires. But as of January 10th, it only had $377 million to pay claims, as well as an additional $5.78 billion in reinsurance. Now, reinsurance is a big piece of how insurers cover large-scale disasters. Think of it as insurance for the insurance industry. But if the FAIR Plan can't cover the losses, those member insurers could have to contribute an additional $1 billion for homes and commercial structures.
If the FAIR Plan runs out of money to pay these claims, and by all accounts it probably will, every insurer that has operated in this state for the last 2 years will have to pay in proportion to its market share.
The plan also caps its residential payments to policyholders at $3 million, which means homeowners in high-income areas could find they're underinsured.
That's a problem we see after every major natural disaster is consistently people are underinsured.
There's so many people trying to access information because the scope of this disaster is huge, and there's so many people on FAIR Plan now.
Despite those challenges, experts say insurers should have the means to cover those claims.
The insurers have adequate reserves because they're required by regulation to have adequate reserves to cover these fires. This is what industry analysts call an earnings event, which means that it's going to impact their earnings. However, it's not a capital event. In other words, They've got reserves for exactly this purpose.
Again, the reinsurance market also plays a huge role in paying for these disasters.
Reinsurance is a critical part of how we finance catastrophes, not just in the United States, all over the world. The benefit of reinsurance is that you have a global spread of risk, and so insurers have varying reinsurance contracts.
The problem for policyholders both in and outside of California is private insurers will likely be looking to shore up losses following the fires, meaning higher rates could be coming for all policyholders.
When you have a catastrophe of this magnitude, you're going to see insurance costs, not just in California, but all over the country, go higher.
It's not going to be a solvency problem for the industry, but it certainly is going to affect pricing going forward, and also perhaps availability in some cases, because insurers are going to have to make decisions about their risk appetite.
The last thing we want to do is to have to retrench or pull out of a marketplace. But it takes all of us working together to create a healthy, functioning insurance marketplace.
So many people have lost so many memories, and the letter my dad wrote me telling me how much he loved me is gone. And it sounds crazy, but I was thinking about my KitchenAid mixer. You remember all the cookies you've made, all the homemade pies for Thanksgiving, and there's so much loss that it's devastating.
Thank you for watching. If you've enjoyed what you've seen, please hit like or subscribe. I'll see you around.